Welcome to Managing Profitable Growth and our session on Value Pricing Analytics. This session is divided into 4 parts, a short summary, and next steps to get you started in measuring and managing these important marketing analytics. Price performance value is a key marketing analytic that is derived from your product performance and price. Product performance is rated using a scale of 0 to 10, where 0 is disastrous and 10 is outstanding, and a score of 5 is average. Multiplying the weighted average score of product performance by 100 creates a product performance score. In this example, 4 performance features were used to assess the performance of the Fuji J10 digital camera. A weighted average was computed using the relative importance and performance rating of each feature to produce an overall score of 63. To truly understand the value of this digital camera, we need to benchmark against the product performance of several competing products. The average product performance was 73, somewhat higher than performance of the Fuji J10. The average price was $206, significantly higher than the Fuji J10 price of $130. A value map using product performance and price for each competing product provides an important view of competitive position and customer value. The fair value line in the value map is what a customer should expect to pay for a certain level of product performance. Customer value is the difference between fair value price and product price. For the Fuji J10, the customer value is $66 based on a fair value price of $196 and a product price of $130. Products positioned below the fair value line produce positive customer value, while products above the fair value line have a negative customer value, as their price is greater than their fair value price. While a position value is important, the next question is, how much is enough? This example shows the price and performance of 60 printers, as reported by Consumer Reports. The HP PhotoSmart creates an impressive value of $55 at a price of $140 and a fair value price of $195. Could HP increase their price and still have an attractive value? If the answer is yes and they increase their price to $149, this value price would add to HP margins and profits while still offering a great value to consumers. Printers well above the fair value line are overpriced for their level of performance. In Part 2, we'll examine the total cost of ownership and how to address value pricing based on a product's price and total cost of ownership. While customers look at price as the most significant cost of purchase, there are many other ownership costs that can impact the total cost of ownership over a product's useful life. Your job as a performance-based marketer is to explore the waters below the tip of the iceberg to discover sources of cost advantage that may outweigh the price of your product. For example, Edmunds.com reports that many Honda models have a higher purchase price than comparable Ford cars. But over the average car life, Honda has a lower total cost of ownership. This is due to lower operating costs and a higher resale value. To understand this approach to value pricing, let's look at an electronic medical device that's priced at $60,000. The competitive product is priced at $50,000 and discounted to an average selling price of $45,000. The company discounts its product $10,000 to remain competitive, but is under constant pressure to lower their price since it's still $5,000 more expensive. While this discussion of price and value are above the price waterline, companies seeking to engage in value pricing need to go below the price waterline to understand the customer's cost of owning their product versus competing products. In this example, we examined the annual cost of ownership and amortized the price for each product based on a 5-year product life. As shown, there are significant differences in the 5 areas of ownership cost. For product life, the competing product has a life of 4 years, which adds an average of $1,800 per year to their cost of ownership over a 5-year period. When totaled on an annual basis, the company's cost of ownership is $24,400, of which $11,000 is the product price. The competing product has an annual cost of ownership of $33,000, of which $9,000 is the product price. Despite the higher initial price, the company actually saves the customer $8,600 per year or $43,000 over the 5-year life of the product. Kyocera provides an excellent example of how to make customers aware of the total cost of owning a printer over a 3-year printer life. Kyocera challenges potential customers to understand their total cost of purchase with their advertising. The TCO Tracker website allows customers to compare the cost of a Kyocera printer against any competing printer for a given customer printing need. In Part 3, we'll examine how to extract customer price sensitivity and value from customers without asking them the importance of price and performance or their perceptions of value. All purchase decisions require trade-offs between levels of performance and price. This value pricing analytic utilizes bundled product options that vary systematically in performance and price. Customers are simply asked which option they prefer. This value pricing analytic provides an easy way to create 9 options that vary in 3 levels of performance for 2 performance factors and 3 levels of price. Customers simply rank the 9 options from the most preferred 1 to the least preferred 9. This is all we need to derive the price and performance curves shown. For this particular customer, segment price was the driving factor in the ranked options and accounted for 75% of the choice variance. Trace quality was the second most important factor, while the repositioning feature had no value to these price-sensitive customers. The company's product positioning produces the least attractive value index at 1.17. Competitor B has the most attractive value index at 2.0. Performance-driven customers placed more value on electrode trace quality and repositioning. Price accounted for only 14% of the choice variance. The real value driver in this example is trace quality, though one-time repositioning of an electrode did have some incremental value. The company would be the preferred choice with a value index of 2.13. Competitor B is the second most attractive product with a value index of 1.63, while competitor A has a value index of 1.50. In Part 4, we'll examine customerization pricing and the importance of a reference price in communicating price and value. For this value pricing analytic, we'll need 3 to 6 performance features and 3 levels of performance and price savings for each. For the full feature reference price, all high-end levels of performance are presented for each performance feature with no price discount. This creates a reference price of $1,500, the price one would pay for a personal computer with all high-end performance features. Naturally, there are a few customers who will want all high-end features and are willing to pay the highest price. Using this value pricing analytic, customers build their own product by lowering the performance level for each feature to a level that meets their needs and saves them money. If customers have a certain budget, they can make the necessary trade-offs to get the best suited product at a price they want to pay. The customer price in this example is $1,000 for the features and performance levels selected. This creates a perceived savings of $500 when comparing the price paid to the full feature reference price of $1,000. The lowest price could also be used as a reference price. A base level product is presented with minimum performance levels and the lowest price of $700. As customers add desired levels of performance, they increase the cost of purchase. At a price of $1,000, they'll perceive that they had to pay an extra $300 to get the performance level they wanted. The basic difference between these two reference prices is that one represents price and performance as a way to save money, and the other presents desired performance as an extra cost. Research has shown that customers buy at a higher price when the full featured reference point is used as the starting price than when presented the same option starting with the lowest reference price. Let's review the value pricing analytic and the next steps for mastering this important area of value pricing and profitable growth. The price performance value analytic presented in Part 1 requires product performance and price data for your product and 4 to 9 competing products. A fair value price and customer value are calculated for each product based on the difference between their fair value price and actual price. A value map can then be created to benchmark the competing products. Using metric 7.3, you can experiment with the sample data provided to develop a better appreciation of how this value pricing analytic works. Estimate the product performance and price position for your product and 4 or 5 competing products in order to gain an insight into your relative value. The total cost of ownership presented in Part 2 opens the door to value pricing for products that lower the cost of ownership. It requires work to get the needed information, but when done, it offers many opportunities to premium price products, as well as change the focus from price to ownership savings. Metric 7.4 provides a way to understand customer value and opportunities to value price. Of course, adding your data with the User Input tab provides the highest level of learning and potential impact. Preference-based value pricing presented in Part 3 is easy to set up and perform. The output provides incredible insights into price sensitivity and how customers value different levels of product or service performance. The value index for your product and 2 competitors is a good barometer of how your sales will go. If your product has a much higher value index, you should be able to attain the highest market share with good marketing. Of course, if your value index is much lower than competitors, it's unlikely you would capture much share with the current positioning strategy. Metric 7.5 provides an easy way to understand customer price sensitivity and how performance is valued. While these are ultimately your perceptions of how customers would rank price performance options, it's a good place to start. Finally, in Part 4, we presented Customerization value pricing as a way to present price and price performance options that allow customers to adjust performance levels to achieve desired purchase price. Presenting your highest priced full feature product sets a high reference price. As customers adjust down performance to lower levels, they're able to save money. Presenting from the lowest price with basic features sets up reference price, where each addition to performance is viewed as an added cost. Research has shown that presenting from the highest price results in customers buying at a higher price point than starting the price presentation from the lowest price. Metric 7.6 provides an opportunity to experiment with sample data, as well as input and save your own data. Thank you for viewing this session on value pricing analytics. Let's close with a reminder that our focus for each session is to learn, measure, and manage marketing performance metrics that have a known relationship with profitability.